Welcome to The Business. I'm Elise Morgan. Coming up on the program, not a rout but a retreat. Sydney and Melbourne driving the fall in national property prices. And a super idea on infrastructure, how industry retirement funds are cutting out the middlemen. Economists were sent into a quandary by the Reserve Bank Board's latest missive today. In the minutes this month, the board omitted its reference to the next interest rate move being up. The line that says members agreed that it was more likely that the next move in the cash rate would be up rather than down, that's been in the last two statements, is now gone. Some economists are viewing this as a sign the RBA is becoming more cautious. It comes as experts are calling the end of the property price boom. Sydney has recorded the first annual fall in 6 years, with Melbourne posting the worst numbers since 2012. And the biggest markets are leading the country down, with national prices on the slide. Auction clearance rates are telling the same story as banks continue to tighten lending standards and a glut of apartments hit the market. Here's Carrington Clark.
It was a perfect day for an auction on the weekend in Sydney's sought-after Inner West, and there had been a lot of interest in the house.
There's a lot of competition here. I heard there's 10 people that registered, so yeah.
But these homeowners know it's a difficult time to be selling.
We're quietly confident.
Bid for the third.
But they didn't need to worry.
Sell it at $1,701,000.
The house going for more than $200,000 above reserve.
All done. Sold your way, sir. Congratulations. Well bought.
But official ABS data shows just how unusual this result is. The numbers show the property price boom is over, with prices falling 0.7% nationally in the first 3 months of the year.
That's probably the difference to a year ago, where perhaps people were, still frenzied regardless of what the property was, where it was.
Blacktown is 37 kilometres northwest of Annandale, but its property market is a world away. This apartment has been on the market for 8 weeks with no offers, and on this Saturday morning open house, no interest.
In real estate, we say you only see serious buyers on rainy days, and we haven't been seeing anybody on the rainy days. So with the warmer weather, we did expect a couple of people through today.
This is just one apartment building in Sydney's west, but agents tell me it's indicative of what's occurring in the broader market. A year ago, there was a frenzy as buyers desperately snapped up property, scared that if they didn't do it then they'd miss out. Now, it's become increasingly difficult to move property for the price that sellers want.
I don't think we've seen anything yet. My expectation is that home prices will continue to slide over the next 12 to 18 months. And, if you're thinking of a quantum, it could be 15 or 20% off the top.
The tightening up on interest-only loans and on improving, lending standards and reducing leverage rates. And that just cools and takes the heat out of the market and naturally pulls prices back down. So, yes, definitely past the peak, I'd say.
But it isn't a consistent story. While Darwin, Perth, Melbourne, Brisbane and Sydney residential property prices fell during the first 3 months of the year, Canberra and Adelaide rose, and Hobart continued to surge.
Those cannot continue the trajectory that they're on at the moment, whilst the major markets are actually going into reverse, and as the credit tightening continues.
The ABS data is 3 months old, but more recent numbers aren't promising. Auction clearance rates have now fallen to their lowest level since 2012, with just 53.8% resulting in a sale. That's about 10% lower than a year ago. Despite property prices falling, property construction continues to boom. But the risk is that when apartments like these are finished, it will add to supply and cause prices to fall even further.
There's another 200,000 units due to come on stream over the next 12 to 18 months into a market that's already falling. And my own view is that's just going to add more fuel to the fire.
1,640.
But falling prices aren't bad news for everyone.
Remember, it wasn't that far long ago that people were worrying about housing affordability. That was the number one political issue 2 years ago. House prices were rising too quickly, so we shouldn't fret just because house prices aren't rising at the rate they used to. And even if they come down, I think kind of for a period before kind of the next rise, that's okay.
And if the property market gets into serious trouble, it might be up to the RBA to step in.
They've signalled for quite some time that they, Governor Lowe in particular, that he sees 1% as a floor for the cash rate. He doesn't think it's a particularly effective tool for stimulating the economy below that level, which suggests that we've only got perhaps 2 rate cuts in the bag.
The Reserve Bank will be hoping it doesn't come to that.
Carrington Clark there. Online retail giant Amazon has launched its Prime shipping service in Australia, but without the perks enjoyed overseas. The annual fee for delivery, called Amazon Prime, has been key to cementing Amazon in the US, where it offers deliveries within 2 hours in some large cities. But most Australian Prime customers will have to wait 2 days for their purchases. Amazon will be hoping the launch of Prime allays concerns of a reduced range as it locks Australian consumers out of its US site from next month. After reaching a near 10-year high, the market finished the day where it began. The All Ords and the ASX 200 ended just a few points lower, and the Aussie dollar has been whacked in the last day. It's now down at 73.75 against the US. For more, portfolio manager at InvestSmart, Gaurav Sodhi, joins me. Gaurav, the market's up around a 10-year high mark again. We've got a lot of M&A activity going on. Is that what's supporting it?
Yeah, well, it's not the banks, and Telstra hasn't been doing very well either. So it's a bit of a surprise to see the market up here where it is. It's certainly there's certainly a lot of optimism out there, and it's been a long, reluctant bull market, but it has been a bull market, and it's now starting to get quite tail happy as well. So it's been driven by not so much the resources in the banks, which usually drive these things, but other parts of the market have become a larger constituent of that index, and those are really the drivers of this. And M&A certainly is playing a big role.
You just mentioned Telstra. It's got its strategy day tomorrow, and today, of all days, it had yet more network outages across the country.
Yeah, I've got a feel for poor Telstra. They're having a very difficult time at the moment. They're spending money in areas that have little to do with their existing business. Telstra is a company that makes all its profit and has all its advantages in mobile and broadband, and yet here they are trying to buy growth in e-health and become the next IBM. They talk about themselves as a global tech business, and for me, that signals concern.
And so what's the share price been doing ahead of this strategy day? Well,
it's actually been surprisingly strong. It's been quite weak coming into it, but rumours about extended cost cuts and a possible restructuring has the market a little bit more excited, albeit from very low expectations. So it's actually been strengthening a little bit, and I think we'll see certainly elevated cost cuts coming from that business from tomorrow.
South32, which was spat out of BHP, of course, a while ago, has made a $1.7 billion bid of its own now for Arizona Mining. What is it doing? Why is it bidding for this?
Yeah, so this sounds kind of like it's coming from the blue. This is actually the culmination of quite an amazing tale. They called South32 Crapco when it was first spun out of BHP. It was supposed to be the dregs of that business, the parts of BHP that no one wanted.
Yeah, just a grab bag of stuff that Andrew Mackenzie no longer wanted.
And there were bits in Africa, there were bits in Australia, there was even a little bit in Brazil. It was all a bit of a hodgepodge of assets. It's actually formed together into a really nice portfolio under the management, who I would say are arguably the best management in global mining at the moment. They have shown remarkable discipline. They've led the way in terms of cost cuts and have a really sensible capital allocation strategy. They've been sitting on more than $1 billion of cash, no debt for a very long time, and now they found their target. So why Arizona Mining? South32 owns a wonderful silver, nickel, zinc mine called Cannington, and it's been one of the best mines anywhere in the world for a long time. That mine is running low, and it shares remarkable similarities in terms of geology with Arizona's mine. So they have a development project, and that mine looks a lot like Cannington. So the thinking is that if South32 can utilise all its experience and knowledge from Cannington and break the metallurgy down and get things going in this new project, they should be able to do quite well out of it. And I think it's a really good deal. It shows the strength of the management there in terms of capital allocation, and it shows what a bit of patience can do if you're willing to exercise in the mining business.
Gaurav Sodhi, thank you so much for joining us.
Thanks, Elise. My pleasure.
The ANZ cartel case has triggered the resignation of former JP Morgan Australia boss Robert Priestley from the ASX and Future Fund boards. The ANZ, Citigroup and Deutsche Bank, as well as 6 senior executives, are facing criminal charges over a $2.5 billion capital raising. Neither JP Morgan, Mr Priestley, nor any of its other current or former staff have been charged over the matter. In a statement, Mr Priestley says he looks forward to the facts relevant to this matter being clarified. One of Australia's largest industry super funds, Cbus, is putting the financial services industry on notice. It won't put up with overcharging anymore. Australia's pool of super is now worth $2.6 trillion, and in 7 years' time, it will be double that. And that ever-increasing pool of money is a target for financial services to reap hefty fees. Cbus is trying to address that by bringing work in-house. I spoke with Cbus Chief Investment Officer, Christian Falk. Christian Falk, you'll be speaking tomorrow about the waste in super fund investments, noting the growth in financiers who are employing financiers, who are employing consultants, who are employing actuaries, and the list goes on. How much is being wasted, do you think?
It's actually very difficult for superannuation funds to understand the true depth of the number of people that are involved in the investment chain. Part of that is because traditionally we have outsourced a lot of our investments to funds managers, and then the funds managers are the ones that employ other advisors, including investment banks and so forth. At the highest level, we have undergone a strategy to bring a portion of our investments in-house. And we believe that within the next 5 years, the opportunity for savings for us, we're a $45 billion fund today, will exceed over $100 million per annum. And we believe that's only at the first level, and there are many levels below that.
So you're looking to lower investment costs by 18 basis points. You mentioned $100 million a year, but there must be a lot more fat to cut.
Yes, one of the model of typical asset management is that when you give fund managers more money, they charge a particular percentage of that. Even if the process means they're just buying twice as much stock. So for asset owners, there's a big opportunity to reduce costs by taking some of those activities internally.
Should all the big super funds be looking to slash costs?
Well, I can't speak for everyone, but certainly for us, this has been a big focus of the way we have thought about and positioned ourselves. I think one of the challenges for superannuation funds is that in order to be confident about taking more money internally, there's a lot of upfront commitment that you need to make in terms of your own systems and your own infrastructure, and I think that's a potential hurdle for particularly many of the smaller funds.
There's currently $2.6 trillion in Australian super accounts. Now, this will approximately double over the next 7 years. With so much money, there's only going to be more and more people trying to get a cut, isn't there?
Once you have sort of made the commitment to bring in internal capabilities, and you start to see where people are taking a cut, you start to realise there's actually a lot of money that sort of goes out of the system. So for us, for instance, we don't need salespeople to sell us product because we're the ones that are identifying the opportunity, so there's a layer that's removed. We've also found that we have the advantage of seeing, for instance, what brokers are charging different managers, and we believe that sharing that information in terms of insights with our fund managers around who's being charged more than we think that they should be is another level of waste that we can sort of focus on.
Are you putting the financial services sector on notice?
Correct. And I think you can only do that when you have a viable alternative and when you really know where the value is, and you can call out where they're charging for something that can be substituted or as of low value.
Christian Falk, thank you for your time.
Thank you.
Good night.